Welcome to your monthly market checkup, where we translate Wall Street chaos into Main Street wisdom. February was quite a ride, like that roller coaster you used to love, but makes your stomach do somersaults today. The tech titans that have been carrying the market, our so-called Magnificent Seven, took a breather, dropping 8.1%. Meanwhile, President Trump's new tariff announcements had investors reaching for their antacids, and inflation concerns are bubbling up again. Because apparently, prices don't think they're high enough already. So let's look at the numbers that matter for your retirement. The S&P 500 took a modest 1.4% dip. The tech-heavy NASDAQ fell a more noticeable 4%. The Dow Jones dropped 1.6%. But here's the silver lining for those of us who appreciate stability. Bonds stepped up to the plate with a solid 2.2% gain. And this is exactly why we don't put all our retirement eggs in one basket. And before anyone starts panic dialing their friends and family about the market, let's remember something the financial news won't emphasize. Despite these end-of-month numbers, markets actually hit brand new all-time highs during February. That's like complaining about the rainy day when we had sunshine for 3 weeks straight. So over the next few minutes, I'll break down what all this actually means for your retirement income, which developments deserve your attention, and which ones are just financial noise you can safely ignore. So after all, your money shouldn't require a Wall Street dictionary. Let's look at this annual returns chart. Now think of it as your investment report card throughout the years. What I thought was interesting was that the S&P 500, that superstar index everyone on CNBC obsesses over, is actually trailing behind several other investments this year. So why is that? Well, it's because those Magnificent Seven tech companies that were carrying the market on their shoulders are taking a bit of a breather. So even with all the AI buzz and ChatGPT headlines, these tech giants needed a timeout. So meanwhile, look who's stepping into the spotlight. Healthcare, financials, and consumer staples. I like to call these the boring but reliable sectors. They're like that dependable neighbor who always returns your ladder and keeps their lawn tidy. Not flashy, but exactly who you want in your corner during uncertain times. And here's something that should make income-focused retirees smile. Bonds are having quite a comeback party. The 10-year Treasury yield dropped to 4.2%, which means bond prices went up. So remember, yields down, prices up. It's like that financial seesaw we've talked about. And this is precisely why we keep bonds in your portfolio, because they're designed to provide balance when stocks decide to misbehave. International stocks, both in developed countries like Europe and Japan, and in emerging markets like India and Brazil, are also showing impressive results. And sometimes the best opportunities are in your own backyard, but sometimes they're halfway around the world. So the big lesson here is diversification isn't just financial jargon. It's your retirement protection plan. While everyone else was chasing those tech darlings, your diversified portfolio was quietly working multiple jobs to keep your retirement income steady. So remember, in investing, it's not about having all your money in whatever performed best last year. It's about having your money spread across different investments so you can sleep well regardless of what tomorrow's headlines bring. This chart tells us something important. Americans are getting nervous about their dollar shrinking again. Consumer expectations for inflation have jumped like a retiree spotting an early bird special. But just look at these numbers. 12-month inflation projections leaped from 3.3% to 4.3%, while the 5-year outlook climbed to 3.5%. So that's like planning for everything to cost a third more by the time today's kindergartners finish elementary school. So the official inflation gauge, our friend the Consumer Price Index, shows we're hovering around 3% right now. But if you're grocery shopping or writing that monthly housing check, you're probably thinking, only 3%? Someone needs to visit my supermarket. And you'd be right. Food and housing costs remain stubbornly high. And here's why this matters for your retirement dollars. The market absolutely hates inflation surprises. It's like showing up at a dinner party with an uninvited guest who eats all the appetizers. When inflation heats up, investors worry the Federal Reserve will keep interest rates higher for longer, and markets generally prefer rates to come down. But before you consider converting your nest egg into canned goods and gold coins, let's maintain some perspective. Today's 3% inflation is certainly higher than the Fed's ideal 2% target, but it's nowhere near those painful 8 to 9% levels that we endured in 2022. So the bottom line, inflation worries will likely continue causing market mood swings in the coming months. It's like living in Florida during hurricane season. You don't just pack up and move, but you do keep your emergency kit ready. So for your portfolio, that means staying diversified and focusing on investments that have historically weathered inflationary periods well. And a little secret between us, some of these inflation-resistant investments are currently on sale because everyone is panicking. And so sometimes it's best to take advantage of these opportunities that are disguised as market worries. Let's look at what I consider the most important chart of them all, the relationship between stock prices and earnings. And this chart shows the S&P 500 index alongside its trailing 12-month earnings per share. So think of earnings as the report card for companies. When businesses earn more money, stock prices tend to follow. It's like the tide that lifts all boats. So the current report card looks pretty impressive. Corporate earnings grew a whopping 18.2% in the fourth quarter compared to last year. And that was the strongest showing since 2021. Even better, 75% of companies beat their projected numbers. So that's like 3 out of 4 students bringing home A's when the parents were expecting B's. And looking ahead, analysts expect S&P earnings per share to reach $266 this year. And for perspective, that's 12% growth, which is well above the historical average. And while your local news might focus on market wobbles and political drama, these strong earnings are quietly building the foundation for your retirement portfolio. So here's the retirement wisdom I want you to take away today. Markets will always have mood swings. They'll worry about inflation one week and tariffs the next and something completely different after that. It's like my father-in-law's golf game. If he's not worried about his putting, he's worried about his iron play or his drives or his short game. Truth be told, he should worry about all of them. So I'm kind of using this as a test to see if he's listening. But underneath all that noise, companies are still selling products, providing services, and most importantly, making money. And that is what ultimately drives your investment returns over time. So while others are getting motion sickness from daily market swings, successful retirees are focusing on long-term earnings growth that has rewarded patient investors for generations. I know it's not always easy to tune out the noise, but it's almost always profitable. So thank you for joining me for this month's market update. If anything I've discussed has you thinking about your own retirement strategy, please don't hesitate to reach out. After all, helping you navigate these waters is literally my favorite part of this job. What that and finding occasional tax loopholes the IRS somehow missed. But look forward to our next conversation, and please subscribe for more retirement wisdom that won't put you to sleep. And if you are sleeping, wake up. I'm done now.